Good afternoon and welcome to the NIGHTCAP PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Sarah Willingham, CEO. Good afternoon.
Good afternoon. Thank you very much for joining us. It's quite disconcerting because we can't see lots of faces. It's always much nicer, isn't it, when you stand in a room? But anyway, it's at least good to be able to do this. Brilliant. So we're going to take you through the whole of the story of NIGHTCAP, actually, because we're assuming that so many people listening don't know anything about our story. You're actually new to NIGHTCAP and why it was set up. So our mission, we floated on AIM in January of last year, and our mission is to be the UK's leading bar group. So we do that through two things. One, we acquire drinks-led hospitality groups, businesses, that we believe have got significant potential in order to be able to roll them out across the country. Now, to date, we started off, when we did the IPO in January, we started off with the Cocktail Club, which is the London Cocktail Club, that had 10 sites, doing very well, with huge rollout potential across the country that we've already started to roll out. The second business that we acquired was the Adventure Bar Group, and they have a number of different brands, actually all of which do really well, but we have very much focused in on the fantastic Tonight Josephine brand, very female-led, brilliant business model, and we'll talk a little bit more to that later on. And also Blame Gloria that we have in Covent Garden and in Clapham that does extraordinarily well, and again has got great national rollout. We've got some sites lined up for both of those that are currently in the pipeline or under construction. Then very excited because we have seen the growth of tequila and the popularity of tequila in this country during the course of the last year through sales in our own bars, as well as some of the research that's out there. And then we acquired Barrio, and that was at the end of last year. That's 4 bars that are Barrio, which is a Latin-based fun party bar with great tacos and the best margaritas you can get in London. We're soon to be outside of London, and also Disrepute, which is the old Kingley Club. If anybody used to go, I used to go in my 20s in Soho, which is a great little bar and does phenomenally well. It's kind of like a hotel lounge 60s retro kind of feel, but again, fantastic bar. So that sort of brings you up to date. We've started our national rollout. We opened 3 cocktail bars in November of last year, which are doing great. The one in Bristol that we opened, which is on Corn Street in Bristol, we normally plan for a 3-year maturity, 2-year maturity. The beginning of year 3 has already hit maturity this quickly, and they're doing very, very well. We're really pleased with that. So they opened at the end of November. So we've already started the national rollout, and we've got 24 sites currently either in legals, advanced, about to sign, about to complete, or under offer. So we're very happy with the pipeline.
And we've also announced the openings of the Tonight Josephine in Cardiff, which is opening in April, the Cocktail Club in Cardiff also opening in April, alongside the Cocktail Club bar in Exeter, all announced, but under construction and just about to open.
Yes, brilliant. So yes, we're excited about that. So just to tell you a little bit, just to introduce ourselves and tell you a little bit about us. My name's Sarah Willingham. I'm one of the founders and the CEO. I've spent pretty much my whole grown-up life, in fact even younger, since the age of 11, in hospitality in some way or other, from a waitress working behind the bar to owning and operating the largest chain of Indian restaurants in the UK. I was the exec director of AIM-listed Clapham House Group. I'm currently investor and chair of Tonkotsu. We have 14, soon to be 15 sites. and I was one of the co-founders of London Cocktail. I was also one of the dragons on BBC Dragon's Den, and I am married to Michael. We always forget to say that, even though we've got different surnames, but we've been married and working together for a long time.
Hi, I'm Toby Rolfe. I'm the CFO. Like Sarah, I've also been in this sort of sector for over 20 years. I started off trading with BDO and then moved into the other side and working for the Brixton Academy in Shepherd's Bush Empire, where we took 2 music venues and expanded it to a national academy chain across the UK before exiting to Live Nation. And then I left to join Be at One, sort of a growing cocktail bar that had 10 sites when I sort of joined, quickly getting to 12. And then we took it all the way to the mid-30s before exiting to Stonegate. So to be given the opportunity to have a third go at this national expansion is something I jumped at as soon as Sarah and Michael offered me the opportunity.
Yeah, and I'm Michael Toxtvad. So my background is really also as an operator. I'm Danish and had the first part of my career in Denmark. Came over here, met Sarah actually quite early on, and we set up our first business together, which was also an AIM-listed business, which was IPO'd on AIM. We took a lot of the learnings from those first couple of listed experiences that we had into what we did with NIGHTCAP. And since then have moved more from operations into sort of the M&A side and the financial structuring, both privately and publicly. So in private equity and venture capital, listed, as mentioned, but also a host of other things leading into, I guess, Sarah and I really coming back together and combining our individual strengths in doing exactly what NIGHTCAP is about, which is taking advantage of a macro opportunity to acquire really good businesses, and then Sarah's excellence around operations in particular and hospitality in making sure that those businesses fulfill their potential. So it's been an exciting journey so far.
And like all good people, you should surround yourself with brilliant people, and we have a fantastic board around us. Gareth Edwards, who is our chair, was ex-managing partner at Pinsent Masons. He's got very, very good on the legal and the regulations side. He also sits on a number of other boards, including various eateries. Toby Vandermeer is the group CEO of Hastings Group that recently delisted from the main market and previously MD of Money Supermarket. Han Jelf, pretty much she doesn't, what's been written about AIM that she doesn't know doesn't exist. She's fantastic on the regulatory side, again, ex-legal. And Lance is sort of almost veteran FD on public markets, who is an amazing support through audit committees, etc. So we've got a really great team. So this is to paint the picture of what NIGHTCAP is and a bit more about the businesses that we have acquired. So we set NIGHTCAP up, Michael just alluded to it, during COVID. At the time when we came up with the idea, there was no vaccine, and we sat there and said, there is a phenomenal opportunity ahead of us to do 2 things. One is to acquire businesses where their balance sheet is being skewed because they've taken on a considerable amount of debt as a result of COVID, but actually their P&L still functions extremely well because of the demand that's out there. So looking to acquire great businesses where often the founders are kind of underwater in their equity and need a new way of being able to get capital in to grow, but also to realize some value themselves. And the second thing was the organic growth. So looking at these businesses where we can heavily motivate the founders and who want to grow, and then roll out quickly across the UK. And the reason we saw that would be a unique opportunity, certainly one that I've never seen in my whole career, was because of the property market. And we saw that over the last couple of years, the balance of power has very much shifted from landlord to tenant. There's a lot of landlords still sat there with unpaid rents for the last couple of years, and they're looking for very strong covenants. Historically, it used to be whoever threw the most money at a site would get it. It doesn't work like that anymore. We haven't seen, we have not paid a premium at all to date. And it's not something that comes up in conversation. It is there because what the landlords are looking for is guarantee that the rent's going to get paid, and they've got a really strong covenant. So coming at it from a PLC point of view, we have one of the strongest covenants available. And we knew that there would be a window of opportunity, of which we have seen for the last year, and we continue to see. The moratorium comes to an end at the end of March, where we think we will see even more opportunity to have these properties all over the country, where we're seeing much more favourable rents than we've seen before, more favourable incentives from the landlords that we've seen before, and again, more availability with less competition. So it was about acquiring these businesses and then having this unique opportunity to roll them out. So we bought the Cocktail Club first. It was award-winning from lots of aspects. We have a number of people that have won the World Championships. The founder was is the judge of the World Championships. Very, very, very well known for its training. We have opened 3 new sites there in November. It's a late night party bar, the London Cocktail Club, predominantly in basement sites. So we've been able to take these historically these less expensive sites and make phenomenal returns out of them, where other people have not been able to be successful in them. What now, actually, as we expand across the UK, we're taking bigger sites, better sites, because they're available for very similar rents to what we've seen before, and we're opening up in some ground floor locations, which is working really well. Corn Street, Reading, and also in Corn Street, Bristol, Reading, exactly the same. Exeter is a ground floor site. All fantastic sites with very similar rent profiles. Cardiff, that we're about to open, exactly the same. Adventure Bar Group was a really interesting acquisition. It's got a number of brands under its umbrella: Tonight Josephine, Blame Gloria, Bar Elba, Lunar Springs. So it's got some of these big ones like Elba and Lunar Springs that are more outdoors. So it's kind of like a lovely hedge for the summer months, where you can have a site that in the winter might do 50 or 60,000 a week. In the summer will do 250 a week, just to put it into context. Net sales, that is. They have an amazing, we call it superpower within Adventure Bar Group, just like the Cocktail Club is with its training. The Adventure Bar Group had this phenomenal business model where they pre-sell a lot of their business before the night. So this is packages and events on a Saturday or on a Sunday where they will pre-sell up to about 25% of their sales. So it's kind of underpinning really the business model during times when traditionally we would have been closed. And in fact, we're taking that amazing team, they really are world class, and rolling that same business model out across the other brands. Tonight Josephine's, I don't know if you've ever seen it, but it's like bright pink, full of women, fantastic brunches. They have their famous Mamma Mia brunch, Brittany brunch on a Saturday is brilliant. Really, really good fun. Barrio Bars, I love. This is the one I always say I could open one in Stoke. So I always think if I could open one in Stoke, that means you can have a hell of a lot of them in the UK. It's a great, great business. Party bars, again, tequila, margaritas, great tacos, fantastic music, often live music actually in a lot of the venues. And again, great licenses. And actually that's something that we have across the group. These late licenses are becoming increasingly more and more important to us as we roll out across the UK. So that gives you sort of a flavour of the businesses that we have within our group. So again, this is a bit more of the sort of macro, again, why we set up NIGHTCAP. We've covered this, a large number of attractive sites, exactly as we said, decreased competition for these sites. So again, it's the covenant that's winning. Strong pipeline of acquisition opportunities. You know, the COVID has really hit our industry hard, sadly. And there are a number of businesses there who need to reorganize, restructure their balance sheet. But actually, as I said earlier, their P&L is really strong. The millennial pound, who we target across all of the businesses, has proven to be consistently very resilient over the last couple of years and continues to do so. Toby will talk a little bit more about the like-for-likes that we've just seen in the last 9 weeks. When the first 9 weeks of this calendar year shows again just how resilient this market is. And Michael will talk again a little bit more about the macro situation of moving away from nightclubs and into party bars. All of that together just makes us positioned extremely well for the current environment. You're on mute.
I'm just going to take you off, Michael.
Of course. Yeah. So whilst NIGHTCAP in its makeup is counter-cyclical, in so much as the timing of opening when the market had a big opportunity ahead of 2 years of lockdown, a lot of the trends that we see ourselves benefiting from had actually started pre-COVID, in the sense that the time of sticky dance floors in nightclubs was on the decline, with an 11% decline in nightclub venues even before COVID, and with the millennial pound growing in influence and the type of nights that they are asking for in terms of the socializing aspects, fits much more the narrative and the safety of going out to a safe bar environment that we provide. All of those trends were already in play, and I think in many ways, with the cocktail market also growing before COVID at more than 6% a year, that sort of trend that we've seen almost exponentially increase after COVID, with a lot of pent-up demand for good nights out. And I think across our concepts, we see the majority of our audience being female. Again, Tonight Josephine is probably on the extreme side, with maybe 75-80% of customers being female or even more. And so to provide that environment is for the millennial crowd, which has had 2 years of sort of almost being locked up. Whenever they've been allowed out, we've seen incredible trading throughout. And yeah, so most of these trends coming out of COVID have just basically continued to play in our favor.
And I think to come on to the results that we've just published, it leads to the point Michael just said about our demographics really wanting to get out after sort of lockdown. And we've got group revenues of 15.8 million for the 6-month period. Included in that is 800,000 or 0.8 million is the Barrier acquisition, because it only came on in the last 5 weeks of the trading period. And also the 3 new sites that Sarah mentioned, they only opened for the last 5 weeks of the trading period. So I think the way we look at the estate now, and coupled with the additional sites we've signed in Cardiff and Exeter, we see this sort of run rate turnover for the business now somewhere between the broker notes for the year ending coming up and the full year for 22-23. So we sort of see ourselves in the 40 million plus bracket, and somewhere in between the 3 and the 7 million EBITDA on a run rate on the assumption that they're all open and trading. What this has produced is a 24% like-for-like increase for the period. So within like-for-likes, we're taking the 5 Barrio bars for that 5-week period, the 7 opened Adventure Bar Group sites, and the 10 TCC sites, and comparing them with the sales they did in the same period in 2019. We've been able to generate a 1.6 million IAS EBITDA, which is basically after with the rent deducted, or 2.5 when you go to the adjusted EBITDA. This has led into 1.1 million of cash being generated, with the sort of difference being the slight unwinding of the rent and trade creditors as at the year end, which was because as at June we were still in the middle of lockdown restrictions, and because the trading only reopens back on the 17th of July. So and I think our results would have been even better for the period. Plan B came in and hit the hospitality sector heavily for the last 2 weeks of trading. Up until the 12th of December, so 2 weeks prior, we were on a like-for-like of 28.3%. I think, as Sarah said, we've acquired the businesses over this year, and so we see 2022 being the organic rollout expansion of these brands. So we've opened the 3 cocktail clubs, we've refurbed 4 sites, and we've now signed 3 further sites, being the ones in Exeter and Cardiff. Of the refurbs, what we've done is we've actually rebranded 2 of the Adventure Bar Groups one into a Tonight Josephine and one into a Blame Gloria, which are the 2 sort of brands we're looking at the rollout. What this has really shown is the scalability of both these brands by changing the Tonight Josephine Clapham site into Tonight Josephine's. We've added 10 grand a week onto the sales, so we've taken it from 12 to 22,000 pounds a week, and this is mainly by adding the brunch offering that Tonight Josephine has, which we'll sort of talk about a bit more in a minute, and doing exactly the same at TJ's Blame Gloria in Clapham Junction. We added on 9 grand a week, which is a 46% uplift. So this has really sort of shown that we are able to really sweat these assets of relatively small spaces, and by bringing in these sort of superpowers, as Sarah said, of the brunch dynamic, it's really, we're able to, what was generally a dead time of trading between 12 and opening time on a Saturday and a Sunday, we're able to sell these ticketed events, so we're getting pre-sold revenue, we know who's coming, and we're able to add significant turnover to our business. So what that has led to is, I think, since the year end, we've been able to keep the like-for-like results and even grow them. So for the 9 weeks ending the 27th of February, we were able to have 24.8% like-for-like growth across the 3 brands. So this is just showing that the demand is there from our demographics, and people are really just keen to get out, and because of the offering we have, we're able to satisfy that demand. And I think what has really been really interesting is the fact that these 2 Clapham sites are, if you've been to them, they're quite small sites. And what this is showing, that with these brunch offerings, it's really, the site metrics are really working in our favor, and it's just opening up a much bigger sort of a funnel of sites across the UK, whereby we can take sites of a relatively small square footage and generate quite high EBITDA and revenue per square foot, which puts us in a good advantage ahead of other operators. So just looking, I think Michael will come on into a bit, is a bit more around the Barrio acquisition, and just looking at the balance sheets. So we've got 9.4 million of cash at the end of the year. We've got acquired debt that we acquired from the 3 acquisitions, which is on really good sort of rate and tenure, because quite a lot of it is CBILS. And so that, again, this is what we see, why we see this as being the organic year, is because we're looking to deploy that 9.4 million and through capital expenditure to open the sites that not only we've signed, but also ones of the 24 further we have under negotiation in order to get to where the sort of or ahead of where the broker note has us, which is it has us at 30 sites for the year ending June 22. We already have 30 sites. The 3 further are opening in the next few weeks, and it has us being at 44 sites by the end of 23. So again, with the pipeline we've got there, we feel that is eminently overachievable. Again, so just running onto these points, I think I've just spoken about the continued like for likes, and we don't see that going anywhere. We just see that following through over the summer now, as the days are getting lighter and our outdoor spaces will come back into their own like they did last year. We had a sort of delayed Christmas period because of the Plan B. A lot of the corporate bookings didn't cancel. We just postponed them, and they've been booked into January, February, and March currently. So again, it's helping to keep these strong growth like for likes, and also means we didn't, whilst our figures to December could have been better, we've actually kept that revenue and profit within the business. And I think, as sort of Sarah said, we've already covered the property market and the fact that we see the NIGHTCAP covenant being incredibly strong, and landlords are looking just for a consistent tenant who will meet rents and be there for the next considerable future. And that's actually opening up other sites that the landlord owns because of our good covenant. Where were we? And also, I think the point is to say the moratorium is about to come to pass, so that could hopefully bring another plethora of sites onto the market. So continuing on, this is really to sort of try and describe our model, and it really is trying to show how simple and easily replicable it is. And I think this is what we've looked at is at IPO we looked at the historic metrics around the cocktail club, and that's what gives us the sort of basis to the standard site metrics there, which was a site doing 15k a week, so just short of 800,000 a year. A site would cost just over 300,000, but at that time there were premiums, which there aren't at the moment. So without premiums is a 300 capex, and developing at mature, which we look at as year 3, beginning of year 3, a mature EBITDA of 225, so an mature ROI of 75%. Now, I think Sarah mentioned at the beginning that two of the sites we've looked at, we've opened in November, being Bristol and Reading. Both are already at mature sales. For the average for the last 5 weeks, Bristol is meant to be hitting 26, and it was doing 28. And Reading was meant to be doing 17 and has hit 19. So these are where we look at in order to get the cash being recycled as quick as possible. And we set 75%, but we are hoping that it will be higher. And I think if we move on to the double site, which is the sort of Adventure Bar's standard metrics when we acquired it, because they were just bigger spaces, what we are discovering is that not only have we been able to make, flex the ABG model by these Clapham sites and open smaller ones, we've been able to flex the TCC model by opening Bristol, which is more of a double site. So we've been able, and what we are looking and finding is, obviously being out of London, the rents are less. So our standard model had a sort of 60k rent in, but I think out of all the sites we've signed out of London, none of them have gone over 120, and actually like Cardiff is 52, Bristol's 80, Exeter's 60, and the other Cardiff is, I think, a step rent between 50 and 60. So again, these are giving us more levers to make sure we achieve that 75% ROI.
It's certainly the best. It's certainly the best ROI I've ever worked with in this industry. It really is phenomenal to be able to convert above 50%.
This might be a good point, just to good place just to give a little bit of overview, just to kind of frame why this ROI is super important to our rollout, before going into the actual acquisition of Barrio. So at IPO, other than acquiring TCC, we raised 4 million for the rollout of TCC, and we then raised an additional capital in May when we acquired Venture Bar Group, which is what's led to us having the capital, as Toby's describing at the end of year this year, of 9.4, and that 9.4 is earmarked for the rollout of these 4 brands. So to contextualize that, we've got 4 particular brands that we're rolling out. So it's Tonight Josephine, Blame Gloria, TCC, and Barrio. And the goal, whilst the market expectation is 14 next year, our internal goal is, between the operating businesses, having the ability of opening 5 or 6 of each brand every year. So that sort of 20 to 24 sites is built into our capex flow, and also the little bit of capex debt that we are expecting to take on in addition to the debt we've got now. We'll still keep our long-term leverage less than or about 1 times EBITDA. But the point is that that within that 9.4 million, there's ample capital to roll out for the next 24 sites over the next sort of 12 to 18 months. And after that point, we will be so cash generative anyway from the sites we've got, and also all the new sites that we are opening, that excess cash can then go back into acquisitions. And I think on top of that, one element is around our share price. We IPO'd at 10p. We then raised more capital at 23p in May. Our share price is currently below that. So this organic growth path we are expecting to achieve without issuing any more shares within the model that we've got. And we then have a particular point that we consider our sort of acquisition window, where the share price needs to be. And we can certainly say that we are expecting that window to sit well north of our last fundraise, in order to not have unnecessary dilution when we are in this particular macro environment, where we are both seeing businesses that are attractive, and I'll come on to that just now, and at the same time, when it is more appropriate to knuckle down on the cheap property for rollout, we can choose to do that, which is exactly what we're describing to you as our growth plan for the next period. Now, the acquisition of Barrio, being the last one, was acquired on very similar metrics to both TCC and ABG. So the pre-COVID multiples that we were seeing in this sector, you would expect to have bought businesses at around 7 to 8 times EBITDA, company EBITDA. And now the average between the 3 companies that we acquired is sitting somewhere between 4.1, and in this case with Barrio, around about 4.5 times. Barrio's doing round about 1 million of EBITDA, and we acquired it for net 4.3 million. So and as you can see from the like-for-likes that we've just talked about, for the first 9 weeks of this year, which underlying are sort of between 20 and 25, depending on the brand, that now feels like the multiple is probably even less than that. And that's kind of what the pattern that we've seen. So the acquisition strategy has really worked for the first 12 months. And as Sarah said, the rollout works really well as well. One thing we've been, I think that's really important to us, is that NIGHTCAP, the idea of NIGHTCAP was always that NIGHTCAP would be an umbrella company that would leave autonomy within the brands to create the magic for their customers, and not lose their identity, and we are sticking with that. But I think the biggest wins we've had is that culturally, the leadership teams across the businesses are really working together in order to achieve the goals that they each have, but also in sharing their sort of superpowers that Sarah will be talking to now.
Yeah, the integration of the brands has been really important, actually, because there's kind of like no point having a group structure if you don't take advantage of the fact that you are working within a group structure. So having done this a couple of times before, and I've actually been lucky enough to be one of the brands also within the group structure. So I've sat both ends of it. What I found has worked before is where, exactly as Michael said, you keep that culture and the drive and the ambition within the brand. But if you can get the groups, the individual businesses within the group, you can highlight what it is that they do brilliantly, and you can then apply it to the other businesses within the group. Everybody wins, and you can guarantee that their magic, their superpower, as we call it, is never the same. So that's one thing that it's taken time, obviously, because culturally they all used to compete and now they're all sat around the same table. So that's taken a bit of time for everybody to bed in and want to work together. But everybody is highly incentivized at NIGHTCAP level. So when the guys go and look at a site, they stand in front of a site, and instead of saying what's best for me, they say what's best for NIGHTCAP. Which is the best business? Which brand should sit in this site? Which brand's going to make the most money? Is this the right site? So, for example, if you look at a Tonight Josephine, and we might have one, possibly two in a city, and this is a big site, we're like, this is the one where we're going to put a Tonight Josephine. Let's put a cocktail club in a slightly smaller one, or one round the corner, or we'll look for a Blame Glory around the corner, and we'll put the Tonight Josephine in the big site. So there's kind of a almost like a hierarchy, but the guys know exactly which brands will work best in which sites, and they work together on it, which is really important. And Toby and I run around very fast around the country trying to follow them, looking at all of these sites. So that's been big. And of course, within a group structure, you want the systems to all align. So everybody's on the same till system. We get the same information, so we can start to have really good KPIs and actually compare like for like across the group, which is great. We benefit from group purchasing, and this is a question we get a lot. So when you look at inflationary pressures that a lot of people are talking about, certainly along the supply chain, we have a really nice advantage that historically you might have been negotiating on behalf of 7 sites or 10 sites, and suddenly to be negotiating on behalf of 30 sites that should be double that before long. Your purchasing power is enormous by comparison. So we are more than mitigating that increase through our power as a group now to be able to purchase, which is great. One of the huge areas of time investment is in people, and it'll be no surprise to anybody listening that it's one of the biggest threats and challenges within our industry at the moment is lack of availability of people, fluidity of people. It is very expensive to recruit, train and lose. We need to recruit, train and retain, and different parts of the business are better at this than others. The group has come together. We are putting together a NIGHTCAP Academy, and we're doing 2 things. So one, we are training now everybody to the highest standard within the group. And the second part of it is encouraging, and I've done quite a lot of press on this recently, is encouraging people to see hospitality as a career. Historically, it's very much thought of as something that's transient. You come in, you're at uni, or it's just a part-time job until I get a real job. The reality is that hospitality has a fantastic career opportunity ahead of you if you get the right training. And as part of our training, we're now bringing in management training and understanding how to actually run a business. And that's really important to us. So all of these things mean that actually the brands, whilst getting on with creating more brands, being more operationally efficient and giving a better customer experience all the time, they're also benefiting from the support and being part of a group. So when you've got a business that's weak in a particular area, we're able to put it in the hands of people who are brilliant at that particular thing, and that they are now taking over and saying, look, we'll do your training, we'll do your sales. I talked earlier about Adventure Bar Group and their pre-sold model. To be able to roll that out across the group is really going to move the needle. So this is great. And I have to say, I've never worked with such a phenomenal exec team that are so motivated and so capable. I really feel that we've got the best in the industry with us. And this is a lovely map that we like to put up because we keep putting more dots on it, and it gets very exciting, very colourful. And you can see that there is sort of method in it. There's a hub appearing in the southwest as we open more and more sites down there. You'll start to see a lot more cluster around those northern sites as well, as the ones that are under offer or in advanced legals start to come through, and you'll start to see more and more dots as the brands go across the country. So yes, watch this space. That map's going to get a lot more colourful. So I think there's two of us moving the button. So yeah, in summary, this is we set NIGHTCAP up to build the UK's leading bar group through acquisition and organic rollout. We've been through the top line numbers. We had group revenue of 15.8 for the half year, which is not representative of the true value that was created because it only had 5 weeks of Barrio in there, and we opened 3 other sites right at the end of November. So again, it doesn't have the full run rate of that. So as Toby said, our run rate is considerably higher than that. We acquired Barrio, as we said, at the end of November and opened these other sites. We've got a fantastic pipeline, and we just keep filling that funnel with more and more great sites. It does take up a lot of time for the team, but it's the most important thing that we do to be able to get this window of opportunity that we see now to be able to get some great sites. And we have enough cash to be able to do it. We will not need to go back to the market to raise funds to fulfill our organic rollout plans that we've laid out. We will have enough money to be able to do that. We will come back to market when the share price has increased, exactly as Michael said, and it will be for an acquisition. So that's it.
Fantastic.
Welcome to NIGHTCAP.
Sarah, thank you. Michael, Toby as well. Thank you indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. Just while the team take a few moments to review those questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Michael, perhaps if I can turn to you. As you can see, we've had a number of questions submitted during the event and obviously pre-submitted. If I may just ask you to read out the question, even who it's from, where appropriate to do so, and just direct it to a member of the team, that would be great.
I will certainly do that. Thank you. Yes, so the first pre-submitted question goes, hi, Sarah and team. Congratulations on the results. Please, could you tell what would you estimate total revenue and net profits if the total estate was contributing for the whole period, as you said that only 70% has done so from the various acquisitions? I think Toby alluded to it in his presentation of the numbers, but if you could maybe just repeat that, Toby.
Yeah, so I think this is the point that the 15.8 for the half year only included 5 weeks of Barrio and only included 5 weeks of the 3 new acquisitions for TCC, and obviously we've then since signed 3 further leases. So as I sort of said, as you roll that forward onto a run rate basis, we sort of see that somewhere between the 2 years of the broker notes being around the sort of mid-40s turnover, 40 million, and somewhere between the 3 and the 7 million EBITDA number. So we sort of see ourselves pushing our way into getting ourselves ready to achieve the next year's numbers.
Thank you. And on to the next one, which is, please, could you talk to us about inflation? What are you doing about staff pay and the corresponding expected increase in staffing costs? Are you confident that you will retain staff? And second part of that question, could you talk to us Who are your major suppliers? What kind of cost increases are they pushing onto you? Are you able to mitigate any of this? We've seen major suppliers like Diageo confident about pushing through significant price increases. I'll take that one, but basically we talked a bit to that as well. So the two aspects, if we start with the cost increases from suppliers, it is very much different to run a 10 million turnover business to now be running what is a mid-40s, and hopefully within the next 18 months be tracking hopefully the 100 million mark, which is absolutely our ambition to get to. And where we are different from others in the same industry is that additional purchasing power really makes a difference and moves the needle. So our goal is very much for that group purchasing to outweigh any cost increases. And if nothing else, allowing us to keep the same margin, doing exactly the same things, which means that over time, we will just be able to provide better value for our customers, which also makes it a more resilient business model if there should be some sort of downturn in the economy. So our goal is business as usual, but actually outweighing those pressures. On the staffing side, Sarah talked to the importance of building in culture, focusing on retention, and particularly our Bar Academy, getting people in earlier to support what we're doing and buy into our culture will really move the needle. It is a transient industry and has been. So with wage pressures, efficiency, culture, and retention, it really does move the needle. And that's one of the most important areas that we have for this year. Third question to you, Sarah, specifically. Sarah, are you continuing to see the property market dynamics you described at IPO? Have market rates started to pick up yet? Are there still prime sites that you're able to secure? Are you confident that you're still going to be able to grow the business as fast as you had hoped?
So yes, I am confident that we're going to be able to grow the business as fast as we'd hoped to. We are still seeing the property market exactly as we talked about a year ago, just over a year ago at IPO. And we're still seeing those opportunities. I would say in some of the prime areas of central London, it's starting to get a bit more competitive than it was. Well, actually, I say that, but there was less available in the prime locations in central London. We're seeing more availability. I think that's linked to the moratorium about to come to an end. Landlords and tenants are having conversations where they're agreeing, knowing that the moratorium is about to end. But outside of London, we are still seeing incredible opportunities. I mean, some of the sites that we've taken outside of London, before we'd IPO'd and before COVID had hit, there's just no way we would have taken them. They would have had huge premiums on them, massive rents. And in fact, we've had, the incentives that we're getting from landlords are really attractive, long 2-year rent-free periods, big contributions to CapEx, lower rents, and lovely long clean leases. A lot of the sites that we're taking are change of use, are new bars, basically. They don't have an existing license. One of the challenges with that is that you have a longer lead time between finding the site and opening it. But the other part of it is it does mean that you're getting a nice long clean lease and you're negotiating something fresh. We do have some assignments, and we still love an assignment because we get the license, we get the planning, and it means we can open really, really quickly. But yes, the beauty of our model is that we will take most decent sites, most good sites, because we've got so many different brands that we would put into them, whether you are 9,000 square foot or 2,000 square foot, whether you're in a basement, a ground floor, or even a first floor or a roof terrace. We will have a business that will make really good returns that we can put into that location. And it really does open up our scope to be able to look at lots of different property. We have, in Shoreditch, we have 4 brands. In Clapham, we have 4 brands. 3 brands. In Cardiff, We have 2 about to open, 3rd one under offer, and very actively looking for a site for Barrio there as well. So we're very comfortable opening businesses, opening our brands next door to each other on the high street.
Thank you. Lots of questions to get through here. So there are 2 questions here that are sort of the same. One is from Pat K, and the other one is all around the liabilities and assets. So I'll read it out, the longer one, which encompasses yours, Pat K, as well. When comparing the year-end results, NIGHTCAP had current assets of 14.3 million versus current liabilities of 11.5. Now, interim show assets of 11.7 versus 13.7 liabilities. So in the short term, we have a 2 million shortfall and a 6 months negative change of 4 million. What are the main drivers for this change, considering NIGHTCAP is an operationally cash generative company? Toby, if you could.
So actually, yeah. So actually, the movement is 4.7 for the 6 months. So which is made up of 2 parts. One is the cash decreasing by 3.7 million, which if you look at the cash flow statement, it breaks it down very nicely. Is how that's moved, which is 1.1 being generated by the business. And then you move down into the investing activities, where you've got the outflow for the Barrio acquisition, and also the outflow for the capital expenditure and the refurbs on the sites. And then you've got the outflows for the financing activities, being the lease liabilities, which is the sort of rent payments and the repayments of borrowings and interest. So that gives you the 3.7 million outflow of the 4.7. And the other million is a movement in working capital, which is predominantly around acquiring Barrio and better trading. So our stocks and inventories got higher because we've got more stock on sites. Our payables have come down slightly, and I think I explained this because this is the rent creditor as at the year ends, because we were still under restrictions, and then receivables has gone up. But basically, those are the key movers within the key drivers that you asked for.
Thank you, Toby. Linked to that is then Pat Case, which is, what is the current cash position, which we've answered. It was the last announcement was 9.4 million, and it says that H1 the current liabilities exceed current assets, and exceeds the current cash position, which then goes on to say this looks problematic. Can you explain, Toby, why?
Yeah, so I mean, within the trade and other payables is a couple of significant balances which are non-cash items, which one relates to the future shares that have been issued to the founders of the Adventure Bar Group on the basis that they hit their earn-out targets. So what we had to do was value what those shares were worth. So that equates to 2.4 million of the creditors. There's also then the deferred consideration for the Barrio acquisition of a further 0.9, which are both sort of non-cash items. The other bit on the current liabilities is the lease liabilities line of near 2 million. This is basically recognizing the rent, the leases, the liabilities we have by the 20-year, 15-year, all the leases we have around our estate. So once you actually take that out, we are in a cash or net asset positive position. So I hope that answers that. Thank you, Toby. I think one here. Do you have thoughts on I should probably read who that is from. Do you have thoughts on accepting NFTs as digital currency in the estate? Not that I really understand them, but I hear lots of noise about them being accepted in the hospitality sector. This is from Nicholas S. I think we're probably a bit early on in the cycle for digital currency being
being an absolute payment method on as point of sale. But what is interesting, and we are looking at exactly how that market evolves, in so much as using NFTs, as you see in some sectors, as a loyalty tool for people who love your brand, can create a lot of engagement as digital tools. And as actually more of our business is becoming pre-sold business and sort of almost an e-commerce way of selling, we are looking at all kinds of loyalty tools that we can use in order to increase that engagement that you would normally traditionally have with your local pub or your bar. So we are looking into it, but it is not something that we have on the immediate horizon.
I'm afraid we have unfortunately ran out of time. So what we will try and do is come back with answers to any outstanding questions at all afterwards and outside of this forum. But thank you so much for listening, and sorry we had quite a few pre-submitted questions, so sorry we didn't get a chance to answer all of the questions that you have submitted during this, but thank you very, very much for listening. And yeah, I hope you want to follow our journey and get involved in NIGHTCAP. Thank you.
Fantastic. And just to reiterate that, the team will be able to review all those questions submitted today, and we'll publish responses where appropriate to do so. Sarah, perhaps before we do redirect investors, just to give you that feedback, if there are any just final closing words, I know we've had a couple of comments from you, but if there's anything further you'd like to say, otherwise we'll redirect the attendees to give you some feedback.
Yeah, it's just to say, it's great to talk about the whole story of NIGHTCAP again. Actually, we've not been through the whole story for some time because our shareholders have followed us, but it's been great to talk about. We're only a year old, and to have acquired 3 businesses in that time, we're very proud of what we've achieved this year, and really pleased with the shareholder value that we are creating in this underlying fantastic business, and look forward to a great, fast, sustainable, organic rollout this year of some brilliant businesses. We'll be bringing some bars up north and across the rest of the country. So watch this space.
That's fantastic. Sarah, Michael, Toby, thank you indeed for updating investors today. Can I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure it's greatly valued by the company. On behalf of the management team of NIGHTCAP PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.